wanted to spend a few minutes today talking about and expanding on this so-called fiscal cliff. The term fiscal cliff was actually coined by Chairman Ben Bernanke of the Federal Reserve. We would look at this more as a slope as opposed to a cliff. It's important nonetheless. We have three separate and distinct events that are all coming together in what could potentially be a perfect storm. First, you have the rollback of the Bush-era tax cuts. Second, you have a sequestration program that over 10 years will cut the federal outlays. And three, you have debt ceiling negotiations. Now, a few things that I wanted to touch upon. First is the basic math involved in why this is an issue. This is no news to anyone, but in the fiscal year 2011, our federal government brought in revenue or taxes, $2.3 trillion. However, spending and outlays were $3.6 trillion. That $1.3 trillion shortfall needs to be made up at some point in time, or at least reduced to a more manageable level. Spending a few moments here on the tax issue. If nothing is done, taxes across the board will go higher. Income tax rates for everyone will go higher. And again, these are all rolled back to Bush-era tax levels, which, by the way, if you look at how much tax we pay now versus 30 years ago, we're paying less tax at all income levels. Both lower, middle, and upper class folks are paying less in taxes than they did 30 years ago. The sequestration is tricky. Now, that's more of a slope. You've got a program that's going to last for 10 years and cut roughly $109 billion each year. Over half of those cuts will come from the defense industry. I don't expect that to be passed or to actually go into action on December 2nd. And all in all, I think Congress, as usual, has been shirking their responsibilities. This is not a new issue. This is not anything that has been surprising. We've known about this for over a year. If you were a business owner, would you wait until the last 30 days to tackle a very large and complex problem? No, but what Congress has done is they've waited for the last month of the year, and to boot, they're going to go on vacation, so they basically have 2 weeks to strike a deal or some sort of compromise. Now, this is not a new precedent. We've seen Congress wait and wait, and we've got to remember they're basically professional negotiators. So we've seen this happen. In fact, we saw it happen in 2010. We had a 2-year extension of previous tax cuts, and it took until December 17th of that year to get those tax cuts extended. And last year, we had a 1-year extension of the payroll tax, which waited until December 23rd to get passed. So again, this is not anything new. It's a serious issue, but yet I think one that Congress is not going to let us drive over the proverbial cliff without coming to some sort of agreement. I don't think it'll be a grand bargain where all sides are happy, because we do have to take our medicine at some point in time. But I wouldn't be surprised to see tax rates go up, and that would be tax rates for the quote-unquote wealthy. We've yet to hear what that line of demarcation is. Is it $250,000 in income? Is it $1 million in income? That's something that's being negotiated right now. But most likely for the wealthy, tax rates will go up. Income tax rates will go up from 36 to 39%. Your capital gains, long-term capital gains tax rates will go from 15% back up to 20%. Dividends will be taxed instead of at 15% at your level of income. What the Obama administration has pledged to do leading up to the election was to not raise taxes on the middle class. So I think that'll be an area where tax rates will most likely be extended at their current levels. But again, this remains to be seen. One area that I wanted to point out is that the quantitative research folks at O'Shaughnessy Asset Management actually went through and parsed the data dating all the way back to 1926 through last year. They broke the calendar years down in thirds, looking at a high tax regime, a low tax regime, and in the middle. And what was interesting is that they found that the worst stock market performance, as measured by the S&P, actually occurred with the lowest tax rates in place. Now, that could be an anomaly, but they extended it even further and said, okay, let's take a look at what happens when tax rates go through a dramatic increase. And we've seen this happen a couple times. Back in the early 50s, taxes went from 0% to 47% on dividends. And even if you look at the 1, 3, and 5-year returns, they were all positive and all above previous 1, 3, and 5 rolling time periods across any tax regime. And that wraps up the first edition of Meyer TV talking about the Fiscal Cliff. Please take a moment to read the latest financial foresights that goes into more detail on the Fiscal Cliff, or as we call it, the fiscal slope. We think there are obviously larger real cliffs out there that I'll address at a later date. Right now, I think we're more concerned with the global economic slowdown that has enveloped China. It's enveloped, obviously, the United States. Our GDP growth rate is at a measly 2%. Growth, yes, but not growth enough to create enough jobs for our liking. Also, we're seeing a continued capitulation with the credit crisis in Europe. So they're making headway there, but there's still a very difficult road in front of them as the deleveraging continues to occur. So with that being said, stay tuned, stay hedged. Thank you.
To find out more about the Fiscal Cliff, read Tim's article, Fiscal Cliff, Perception is Not Reality, on the Meyer Capital website at www.meyercg.com.